Welcome to my third video on fees and investing, and I'm bringing together factors, namely fund fees and taxes from the prior two videos, and I'm adding in a third factor, namely inflation, on this particular slide in front of you today. Now, as before, the very top line on this graph shows the returns of the S&P/TSX Composite Index. That's an index of large Canadian stocks. You can think of it as the Canadian stock market. And it's the growth per dollar invested in 1970 through to the end of 2014, and $1 turned into just over $50. Here I should point out that the y-axis, the up and down axis, is a log axis. So what's happened is it's been squished all together. So you can see that the scale jumps pretty dramatically from $0 to $1 to $10 to $100 as you go up the scale. And the reason why I've done this is so that you can see detail earlier on in the graph, in the early years, which is important when it comes to inflation. Otherwise, it would, you'd see this sort of exponential type curve, a big growth with ups and downs along the way for sure. But it would hide that early period, which is important in this graph. But again, the very top line represents the returns of the market. The line below that assumes that you've invested in a pretty mediocre mutual fund that charges 2.5% annually, and it just gets the returns of the market before fees, but after fees, the returns are reduced. And so that turns an ending portfolio value of north of $50 into just under $20 at the end of this admittedly long period. Now, if we impose a 23% capital gains tax, like I did in the earlier video, this is 23% on any gains, and it's levied annually. So this is a pretty bad case scenario. Nonetheless, you do that on this portfolio. So we've taken off the fund fees, then we pay the capital gains tax annually. That brings you down to about $10. The last factor that I want to talk about today is inflation. And that's the propensity of the dollar to lose purchasing power over time. So the idea here is that today you might be able to buy, say, an ice cream cone for maybe $4 or $5, whereas maybe 20 years or 30 years ago it would only cost $1, and many decades ago maybe it only cost 50 cents. So that's prices tend to go up over time. That is, the value of the dollar tends to go down over time, and you can see the impact of inflation here. Is a really big impact. Inflation was particularly a problem in the late 70s, early 80s, which is why I went with the log graph in this case. And you can see that you're starting off with $1 invested, you wind up with just a little bit more than $1 at the end of the day. So here, this theoretical investor has taken on all the risk of investing in stocks. They've paid a large amount of fees, paid a large amount of taxes, they've been hit by inflation, and they're left with very little. They've taken on all the risk, and they've got hardly anything in the way of returns at the end of the day. And this is to emphasize, I don't want you to sort of say that investing is not for you, but I want to emphasize that you want to reduce fees and taxes where possible and legal. And if you pay high fees, you're in trouble. There's not too much you can do about inflation. It's going to be a factor. Potentially you can buy something like a real return bond, for instance, but that's on the bond side of things. Nonetheless, you do control the fees and to some degree, at least the timing of the taxes that get paid, and you again opt for RSPs and tax-deferred type accounts to try to get a little bit more return for the risk that you're taking. And so that's the, in a nutshell, that's the moral of this graph. And don't give up hope, but keep an eye and and cut those fees where you can, and either opt for the tax deferred or tax advantage accounts where you can again, and hopefully that inspires you to take a second look at exactly what you're paying your advisor. So with that, thank you very much, and I'll probably move on to other topics in the next few videos. Thank you again.